Hi, everybody. This is AJ with Trading Trainer, and this is the first of 5 sessions that we are going to be doing as part of our partnership. Let's go ahead and start by sharing my screen. All right, fantastic. So I believe that you are seeing my screen. Now, what we're doing here is a small 5-night course every Wednesday, a small course on probability curve analysis, specifically in stock charts, equity charts, and specifically for the purpose of trading options. This evening, let me go ahead and take some notes here. I'm just going to put this live out there for you. This evening, we are going to kind of discuss why. So let's take a couple notes here. Why use a normal distribution curve analysis? And the other component that we are going to discuss this evening, and this is just a short half-hour call, the other component that we're going to discuss this evening is what sorts of patterns work. On following sessions, we will talk about how to actually calculate them, how to actually use them, and some advanced strategies on using some analysis tools that are free out there to make it a lot easier, okay? But for tonight, we want to talk about why use normal distribution curves. Now, you might be asking yourself, well, what the heck is he talking about? So let me go ahead and open up a browser window here. Let's go ahead and just search on, we'll go to a nice Google window. And I'll actually go into Google Images. And let's search on normal distribution curve. You can get an idea what we're talking about here. Now, this is actually, if you've taken statistics sometime in your past, this is actually a Statistics 101 type analysis. And what this is saying is, in the case of a normal distribution curve, and you can see there's a whole bunch of different thoughts behind this. That one looks a little bit too complicated. Let's take it easy on ourselves. Let's look at one. I really like this one. This one's very pretty and colorful. So let's view that image. I'm going to zoom in on it for you. And what this is saying is, in a given situation, assuming that there's no sorts of skew involved, and we'll talk about that in a second, your data as it comes, if it follows a normal distribution curve, will fall from where you are. 34.1% of it will fall 1 standard deviation to the right and 1 standard deviation to the left. So should you just bound your data by plus or minus 1 standard deviation from where you are, 68.2% of your data will fall into that. You know, that's a little bit over 2/3. If you go 2 standard deviations, each standard deviation after, the area under the curve is 13.6% of the total curve. So if you go 2 standard deviations in either direction, 95.4% of your data is going to fall there. And then the 3rd standard deviation, you have another 2.15%. So if you go 3 standard deviations from your existing position in either direction, that's 99.7% of the data can fall there. So we like to use this probability curve analysis on stock moves because we like to calculate where do we think that this stock move could be in order to trade it appropriately, especially if we're leveraging our move with options. Does that make sense? Now, this normal distribution curve is not going to fit everywhere. If you can imagine, we sometimes can have a skewed curve. So the skewed curve would mean that there is something, I'm just bringing up a virtual chalkboard here, something that blocks our normal distribution curve and creates a skew to one side or the other. Now that probability skew is actually very hard to mathematically calculate. It doesn't follow a normal formula. You need to get into some additional forms of analysis, and then of course the accuracy of that falls off. So we actually, in a case of a known skew, we probably won't use our probability curve analysis to analyze the one of the problems, and you have to be aware of this, is there's a lot of free tools out there that will mathematically calculate your standard deviations, your probability curves, and it's up to you. Please listen very carefully. It's up to you to know whether the normal distribution curve fits your data, fits your chart. Because if it doesn't, and you allow one of these tools to plug and chug and create your standard deviation, create a normal distribution curve, and you follow it blindly, you might be getting a ton of false data. And I'd hate for you to be trading on false data, because that usually results in a loss of money, a loss of your money, and that's not where we want to be. Hope that makes sense. All right, so some of the data that we can get out of this normal distribution curve, one of the most important things to kind of pay attention to is how narrow, and I wish that was symmetrical, but I'm doing my best. Let's try that again. Better. How narrow or how wide this normal distribution curve is. Right? If it's wide, it means that there's a more implied volatile move that can happen. In other words, if it calculates out and one standard deviation that includes a little bit more than 2/3 of the sample set is very wide in each direction from where you currently are, it means that we expect some heavy volatility. Now that could be both good and bad, and there are some situations where we'd actually like to predict that it will get wide, but it's currently narrow. Okay, but let's look at some sample charts and determine where indeed we would use one of these normal distribution curves. What is the pattern? My main goal for the night is to understand what sort of patterns work with this. Okay. Let's do that. Actually, before we jump into that topic, let's spend about 5 minutes making sure we really answer why normal distribution curve analysis. I've kind of intimated that, you know, knowing the probabilities we would fall on a chart in either direction from where you currently are is a good idea. When it comes to option trading, one of the benefits here is knowing where we can place some what's called time decay, or theta decay is a more accurate term, premium type trades, trades that we're trading based on the options innate characteristic that it is a wasting asset. One of the drawbacks to a lot of options analysis or even option strategies is that if the underlying price of the stock gets anywhere near close to where the strategy has been placed, you can be in trouble. So the probability curve analysis fits very well here, because if we place our option strategy far enough away from where price currently is trading, we will have a low likelihood that that premium trade, as it decays naturally with time, will be disrupted by underlying symbol price getting in the way. So that's one use. And again, I kind of hinted at, being able to predict whether a probability curve will change with time is also a helpful way, because a lot of our option strategies are directly related to this probability curve. In fact, let's talk about some of the factors into calculating this probability curve. One of them is how much time we expect to be in a trade. Okay, how much time do we expect to be in a trade? That's going to directly affect how far out our standard deviations are. Okay. Another component that's very important is to understand what is the middle point. Where are we seeing the middle of this normal distribution curve? And here is, again, another problem of just using off-the-shelf probability curve analysis tools without it being placed strategically on patterns where it's most applicable, because those things will just calculate your standard deviations, and if it's the wrong fitting standard deviation, you can be in trouble. Okay, so we'll again talk about that a little bit more. Finally, there's one more component, and that is what is the volatility? All right. Now, when we do our probability curve analysis, we could use historical volatility, and this begs a discussion about what is volatility. There's a couple of different volatilities that we measure. Historical is probably the easiest to grasp. Historical volatility is calculated by, let's just pull something up here. I'm actually going to log into my Trading Trainer web portal. This is a web portal we use with our learning community participants. I'm just going to go over here to charting. And let's just pull up a familiar ticker like Apple Computers. So I'm just going to look at a plain Jane 6-month daily chart with linear scale, open, high, low, close bar, separate pane for volume and volume average, and take a look here. Now, historical volatility is traditionally measured close to close, or even includes, if you're looking at daily volatility, how much price action you have in a given day. So if the price action is large, that's high volatility. If the price action is small, that's low volatility. Okay. So we can look back. We have an indicator called the average true range, and we can actually take that average true range and look at what volatility have we been seeing up to this point. Now, I like to compare that, with an analogy to driving a car. So when you drive a car, if you're looking at the rear view mirror of where you've been to get an idea of what's coming up, you might say, well, I've been seeing curvy roads, so I expect more curvy roads. Or I've been driving through the west side of Texas, where it's a lot of straight for as long as you can see and not much else, and I expect to see more. So using what you're seeing in the rear view mirror in order to get an understanding of what's coming up. Now there's another volatility measurement that we make. It's called implied volatility. And this implied volatility, get this, it's actually calculated on the secondary market around a ticker symbol. What? All right. So in other words, without a futures or options market, that's the secondary derivatives market, we would not have an implied volatility for an underlying symbol. How does this work? Well, the options market is kind of like an insurance business, a hedging market. It's a market of related securities that people use to protect themselves should the main security have a problem. And then alternatively, some people just trade options directly. But for the most part, the options market was created as a hedge. It's almost like, in a stock situation, we're constantly asking ourselves, will this go up or will this go down? Then in the options market, you're constantly asking yourself, do you think that they were right in betting that the market will go up? Or do you think that they were wrong in betting that the market will go up? And vice versa. Do you think they were right in shorting a position, or do you think they were wrong? You can use these options as hedges. So if you're long a stock, if you've bought a stock and you're hoping that it appreciates so that you can sell it later, you can actually also buy as protection an option security that will profit if the underlying symbol goes against you. It's kind of a form of insurance, right? It's called a put option specifically. So you can buy that put option if you think that there's a chance that the stock might turn against you. Now, of course, if a lot of people think this stock is going to turn against you, a lot of people will be buying puts. And what happens if there's a lot of buying pressure? The price of the option will appreciate. And of course, if people don't think that there's going to be a chance that the underlying security can turn against you, people will be selling their puts. They don't need them anymore. And when there's a lot of selling pressures, the price drops. Now, there's another variable that has to be kept in mind when it comes to a secondary derivatives market, and that is these things have an expiration. They are wasting assets. Suffice to say, many mathematicians have modeled these secondary markets and how they relate to the primary markets. And they can factor out the time component. They can factor out even the underlying symbol price component. And what's left is the buying and selling pressures. And so by looking at the actual trading that is happening on the secondaries market, in other words, whether people are buying insurance or not, you can get an idea of the volatility that's expected in the future. It's called implied volatility. It's calculated off of the hedging market, the secondary derivatives market. It's quite unique. So if a lot of traders are expecting a storm to hit, we'll see that in the implied volatility measurement, because we'll take data sets off of the amount of buying and selling that's happening on the secondary market. We'll factor out time, we'll factor out the underlying symbol, and we'll wind up mathematically getting something called the implied volatility. So back to my analogy, it's as if we're looking out the windshield of the car and we're predicting what we're going to see moving forward. So one is looking out the back window of the car, one is looking out the front window of the car. And what's interesting is many times the implied volatility doesn't match the historical volatility. And that's definitely true with my analogy as well. A lot of times, yeah, you've been driving straight, but now it's going to turn curvy. So we often, as traders, like to compare the historical to the implied. When it comes to our nice tangent, when it comes to our normal distribution curve, we typically like to use the implied volatility numbers to understand the buying and selling pressures of these things. So again, let's update our notes. What is the volatility? And more specifically, buying and selling pressures on the secondary market. Okay, with those three factors, we can get an idea of how this normal distribution curve should look. So we have to make sure we have a stock pattern that fits this thing. So let's look at some examples. What we want to do is make sure that we find something that is horizontally channeling. Okay. And I don't care if it's horizontally channeling or horizontally diverging or converging, just so long as it's symmetrical and going down. Okay. So Apple may not be the best candidate. I'm looking at a 6-month chart, but let's look at a weekly chart. 2 years. What you want to be able to identify is clear support, clear resistance, and the more times it's been tested, the better. Apple doesn't look like it's a very good candidate for us. Let's go down the line. I was just taking a look at General Dynamics. Now, if you look at General Dynamics, since about October of 2014, this thing has been finding a level of support, maybe right around here, and a level of resistance maybe right around there. Let's actually go now, that's on a weekly basis, and you can do a probability curve analysis on a weekly basis, but let's also look at 6-month daily. So does this still apply? Again, a good horizontal channel has at least one test of support and resistance. The more tests, the better. Let's see what else we can find. How about a ticker like Las Vegas Sands, the casino company? Would this be a good candidate? It looks like we're actually coming out of our zone. How about something like a Domino's Pizza? We all like pizza. This also looks like it's coming out of its zone. How about, I don't know, a Facebook? Ah, I like to use closing prices. Could we identify that as a channel. Again, the longer it's been going horizontal, the better. The more times that it's been testing support and resistance, the better. Because what we're trying to do is set up a nice normal distribution curve that we can overlay, and just makes sense that it's not skewed in one direction or another. By the way, we can for sure use point and figure charts to do this as well. Here's a point and figure chart. Let's look at Facebook again. Now, based on this point and figure chart, maybe a volatility graph, or I should say a probability curve analysis, isn't the best. How about loading up General Dynamics? Maybe General Dynamics is a good candidate. Take a look. Looks like we've got reversals at 130. Looks like we've got reversals at 145. Now I'm curious. Let's go back to General Dynamics and look at 130 and look at 145. Let's go to a year. Let's go to 2 years. Let's go to 5 years. Now, if we calculated a normal distribution curve on this data, if you can imagine, we would have an understanding, just because we have been testing support and resistance, where we would follow along that channel. So this might be a good candidate for doing just that. Hope you're starting to figure it out here. Go back to 2 years. Let's take a look at Chevron. Can we use Chevron? Maybe not. Should we just step through some of these candidates that I've got on my particular watch list and see if we've got any? This is Amgen. Let's pull Amgen up also on a point and figure chart. Ticker AMGN. We have a horizontally moving chart. We can identify a support and resistance, and if we were to place a normal distribution curve here, just looks like it would make sense. Starting to see? Apache, maybe not. Amazon, maybe not. APC, again, you really don't need, I mean, we're looking at 2 years worth of data. You could just have a few months of data. You just need to have it tested a few times. The better the data, like look at Boeing. If we went down to a 6-month chart, I could see us doing a normal distribution curve analysis on this data between 125 and 135. And where would I place the middle point? Well, 130. See, if I was to place the middle point where we closed today, which is by default what a lot of these tools do at 133, do you see how it would be a skewed normal distribution curve? So when we calculate it, we want to offset it, or we want to make sure it is right in the middle. Should we look up some additional examples? Bed Bath & Beyond. I see that support is here. Maybe resistance? Here's Bunge. Maybe not. Baidu? Here's actually a diverging channel. Will that work? Absolutely. Absolutely, so long as it's symmetrical. Anheuser-Busch, Buffalo Wild Wings, Caterpillar, the CBOE. Let's go back to 6 months. I could see doing a normal distribution curve on the CBOE. So I think you get the point. Quick review. Why would we use a normal distribution curve analysis? To get an understanding of what sort of probabilities we have that price will move from where we currently are, right? And that gives us an inside scoop, at least another data point on not only where this might wind up, but also where we can place strategies, especially option trading strategies, to make sure we're not in the way or to take advantage. What sort of patterns work? We've been going over the horizontal patterns and how to identify them. Need to have clear support, clear resistance. The more times it's tested, the better. Got to make sure that we place it in the middle so we don't get a skewed normal distribution curve. In the upcoming weeks, we're going to talk about how to actually calculate the standard deviation. We're going to talk about how to actually trade the data that we get off of the normal distribution curve. And we'll show how to use some of the off-the-shelf option analysis tools to make this a much easier analysis to do. So that is the end of day 1's session. Can't wait to see next week when you come on back. That's all I've got. Please take care.